another session of the Look Back podcast. And I am here with Peter Walker, the head of insights at Carta. But before I introduce Peter, I want to say I have a special collaborator on the call today. This podcast welcomes Bobby Napolitano, the head of the GTM firm and a former head of the App Exchange at Salesforce, the first CRO at Twilio, and a self-confessed startup junkie who's worked with dozens upon dozens of startups, helping them find that path to growth, acceleration, and ultimately exit velocity. And we'll talk with Peter a little bit about how you accomplish those things in terms of data. You're the master of insights, the data storyteller at Carta. And I'm so glad to have you on the show. You do a wonderful job of feeding the community with such great startup information on who's getting funded, by who, and how much, and at what stages. I first, on behalf of the industry, thank you for all that outpouring of sharing. I know it's your benevolence and maybe a little economic benefit because this company, Carta, does accept cash for all the great work it does. Now, I know you as being the standard bearer of cap table software. I mean, you have predominant lion's share of market share in the world of cap table, which means the venture capitalists, the law firms, the
Yeah.
founders, all relying on you and your data, which is what gives you the access to this great insight. Give us
Yep.
a brief description. First, welcome to the podcast. I'm so happy to have you on board.
Thank you so much for having me. This is going to be a great conversation.
Yeah, I'm fired up. So, and Bobby is beyond that. So here we go. How are things at Carta? And give us your background on how you got there and what you're even working on today.
Oh man, things at Carta are awesome. I feel very privileged to be here, to be honest. As you said, sort of like a little herald for venture capital data out in the ecosystem. So Carta, as you mentioned, it's started life as a cap table management company. We have about 45,000 startups now that use us for cap table issuing equity to employees, advisors, investors, all that stuff. And then over the last couple of years, we've actually grown this whole other fantastic business around fund administration. So helping venture capitalists run their back office, portfolio, valuations, audit, tax, the unfun parts, the unsexy parts
Yeah.
of running a venture fund. We help you handle those, and then you get to invest into great founders. My journey to Carta is like by far the biggest place I've ever worked. My journey was I started a little company in college and then I bounced around at small startups early in my career. And I think after Carta, I'll probably go back to building something really, really small with a good group of friends because there's really nothing like it. And I hope more people get the chance to try it.
The people with your background in data and what's happening right now in AI, you probably have offers coming to you on a regular basis. But
I have
uh,
offers to evaluate startups. I don't know about job offers. I get
okay,
I get a lot of like, what are you thinking about this one, you know?
yeah, I'll call you after this.
I
Anyway,
was just going to say that we could use a body like you over at the firm and what we're building. And when you think about the data and the direction, it's really, can we be Magellan and the compass? How do
Yeah.
we avoid no false starts? What are the things? And if you think about the view in which you get, you may have one of the most unique in the world.
I think that's very true. And it's again, I feel pretty lucky to be here and Henry, our CEO, allowing me to sort of dance through all of this data. Hopefully, it's providing a lot of value back to the
that's what I was going to
ecosystem.
say
But
because there's one thing to having access to it, right? And there's
sure.
another thing to turning that into value.
Yeah.
Right?
Yeah.
But I know that people do love the presentation. So let me just start with a softball, Peter. In kicking off this conversation, who's getting funded today in this whole AI tsunami world that we're living in, and the
Yeah.
world with robotics and all this other great technology coming out? Who's getting funded and why?
Hmm. Well, you said the magic word or the hated word in some circles here because people are getting a little tired of it, which is AI, of course, has been the dominant story across Silicon Valley and all of startups over the last, call it two plus years now. I think the general sense from our data is all of those headlines are true. AI founders are getting funded at higher rates for higher valuations and more cash in every stage across the ecosystem. Of course, that begs the question, what is an AI company? What counts as an AI company? There's been many debates about, do you have to build foundational models? Is it okay to just call ChatGPT's API, et cetera, down the line? when you look at the data, the interesting thing is it doesn't seem as though, while there are significant gaps between, say, someone trying to build a startup to take on OpenAI or Anthropic and someone who's just trying to solve an industry problem using AI in their workflows, both of those things are getting funded at higher rates by investors. So one of the things that we are talking to founders about is you don't actually have to build your own models. You don't have to be some sort of deep AI research scientist, but you should be adopting this latest technology into your workflows with the point of solving customer problems that actually matter. And we've really seen an explosion of what were derogatory called wrappers, but are actually just wonderful businesses using the latest technology. I think that is kind of the wave of 2025. Beyond AI, there's a whole host of things. The way that we talk about it, especially in terms of location, is there used to be this idea that you had to be in Silicon Valley or New York to start a startup. And I think that's totally untrue these days. There are so many places across the US that have wonderful, welcoming, fertile ecosystems to build early stage companies. What remains true is once you get big enough, there is this sort of siren song towards San Francisco where a lot of later stage companies end up being here, opening offices here, talking to investors here, of course. And that dynamic of start anywhere, but probably as you scale, you're going to interact with Silicon Valley. I think that's actually a fairly healthy one that we've seen in the last couple of years.
Is that because you're later stage and you've now raised enough money you can afford the rent and the people? And because when you say that, it's not like I can lift, shift, and move my group. I actually have to account for a 30 to 50% increase in expenses.
You do, although the
And I
rounds
got
are
to
at
worry about,
least that much bigger.
right. Well, I
So
got to also worry
actually,
about competing for talent too.
you certainly do. That's right. And there are proponents of San Francisco. I think Gary Tan at Y Combinator and others, most among them, that would say in this conversation, good, compete for the best talent. Like they live here, you should be here. I think you can actually find great talent in many, many places across the US. And actually, one of the interesting things from our data is early stage startups are actually increasingly looking abroad as well to bring on whole teams, sometimes outsourced engineering, outsourced design or marketing, et cetera. So I think there's 1,000 ways to build a great company with talent. But Bobby, you actually just touched on a really interesting nerve that's going around in startups, which is how many people do I actually need? The biggest change we've seen in our data over the last 2 years is the number of people that work at these startups on the day they raise big rounds. So it
Size of
used to be like Series A, you'd have, call it 18 to 20 people, maybe full-time employees at a Series A. Now it's more like 15, maybe more like 13 soon, and kind of getting smaller all the time. Lots of people want to attribute that to AI. I'm thinking at the moment, over the last year or so, it's been mostly about capital efficiency and maybe some decline in fundraising. But as we move forward, I do see a big trend of people trying to automate things that they used to put headcount against. So small startups moving really quickly. It's sort of the general theme across all of our data.
And does that trend continue along B and C series companies with less team?
Absolutely. It actually gets bigger.
Yeah.
The gap from where they used to be in, say, 21 to where they are now. Again, people like to paint AI on top of a lot of things that are actually just being more capital efficient, but I'm sure that the AI voice will kind of come through in that data soon as well.
Yeah. Peter, are you seeing anything in terms of the number of companies that are getting funded today
Yeah.
at the early stage? Is it the same percentages for the last 10 years? What's happened over this period? And is it coming from the same sources, or are we seeing a broadening out of sources for funding?
Percentage wise, that's a really difficult thing to measure because, of course, we don't know all of the companies that are attempting to raise venture capital. I will say there have been two sort of big shifts. The first is there's so much more activity on pre-priced funding than there was even 5 years ago, that the whole world of safes and convertible notes, where most early stage founders get their initial capital, that can come from 1,000 sources: friends and family, angels, institutional VC,
Right.
CVC, private equity in some cases. Like there's like a whole world of early stage funding sources that are getting more and more diverse. unfortunately, from our data, I don't see a gigantic leap in the number of businesses actually being funded. Some of the capital raised looked better in 24 than 23, but those were mostly on the count of bigger rounds as opposed to more companies actually getting funded. So what we I like to paint this picture of venture capital as we're in a hangover period, or we were for the last couple of years, versus from the we got a little too drunk in 2021 and did some silly things, and then we were sort of paying for those silly things for a while. We're starting to exit that period, but we're nowhere near the level of total businesses being funded as we were, call it in 21 in the heyday.
And those ripple effects will last for decades. No
I
young VCs are getting batting practice. We don't, the kingmakers are happening and we don't even know if they're king worthy.
yeah,
Right? Well, let's be honest. And
yeah,
so many innovative startups are struggling for what you just said because that early seed, and I was rereading your article today, is what's the new 20% of a seed? Is it 10? What is it? Do I need less is more?
yeah.
And is it maybe second time founders versus first time founders? There's probably so much to build and dig into that data, but I'm in complete agreement. We don't need what we used to need. And how do we educate that? And the one that I always point to is how do we WhatsApp every company?
Mm,
Eight employees, $19 billion. Does it get better
right.
than that? And it came from a state school. It just
Yeah,
happened to be that state school was in Silicon Valley,
right. Keith,
right?
well, here's a question though. I'm totally on board with the idea that a lot of these startups need less talent than they used to, or need less people, as talented as ever, of course. But it does present this thing that's worrisome to me a little bit because I got my start in startups and I want that to be available to people because I wasn't ready to be a founder when I exited college, really. I had started a company, but I probably shouldn't have. But I was ready to join an early stage startup, be one of the first 10 employees, and learned more in those 2 years than at any point in my entire career. And I want that
Wow.
to be available to
Yes.
people, but I don't know. Like we may have passed peak startup employment a couple years back.
No, I think we actually have to readdress where the problem exists, which is why we're spending time in schools.
Mm,
Entrepreneurship is being taught at the engineering level, so you don't have to go to Y Combinator to get a clue, right?
yeah.
Like just think about those were bumper guards for bowlers that didn't want to roll bumper, gutter balls.
Mm,
You had Y Combinator and Techstars on that, so you didn't, but you don't need the gutter ball like anymore. To your point, we can be anywhere. It's where's the strength of smarts? Where
mm.
is the opportunity maybe from the commercialization? And then is that the new spiral that you can actually do from, which is why we're trying to spend as much time in some of these engineering schools. Because if you think about how you go deeper or broadly based ones where they're teaching that intersection, because
Yep.
I do believe the next problems will be solved by not people my age. I don't have
So Bobby,
problems.
you're really pointing to university as being a better teacher of entrepreneurship.
100%. And you're
Mhm.
seeing a buddy of mine from Salesforce is in EIR at Penn State. Like I'm
Yep.
seeing EIRs coming from industry to come help them, which is why I'm spending time. I'm here at the University of Alabama this week. I just left the robotics lab this morning. Is that this innovation and what they don't know is the intersection of commercialization. And that's really where you go to venture and get that money to understand and explore that. So if we
Yep.
could cut that off at the pass, what could it look like?
Interesting. I
Well,
think I hope you're right. I really do.
Have to
And
be right. We have to be right. Otherwise, we have the bottleneck called Silicon Valley. Guess what?
yeah,
We don't need to make that trip to Mecca.
yeah,
It's not the pilgrimage people think.
yeah. I'm in agreement with you completely. I think you can begin and you should begin your startup wherever you are and take advantage of all the latest tools. I do look out and there's well, it depends on what you think of the durability of some of this AI revenue. Is everything just going to be a tiny team with a ton of AI agents kind of running around with them, or are there sort of lasting advantages to having more capital? I think we're in a very interesting period where that is up in the air. And hopefully we kind of come to some conclusions over the next couple of years.
But I'd like to have your opinion on how does this parallel to SaaS? Because if you
Mm,
think about it, startups couldn't acquire software because you didn't have IT departments and hardware and the money. And the SaaS allowed you to overconsume, which is why the SMB has 200 SaaS apps. I'm thinking, what do they even have? You need five.
right.
And so if you think about it, it's the same thing for AI, isn't it? I don't need as
Maybe.
much. I can afford, it's more affordable. I don't need as much. I can do
Yep.
more with less. And it's just
Yep.
the next thing.
I agree. That's where, I mean, our data points entirely in that direction where you are being, there are startups that are kind of approaching the idea of fundraising in varied ways, whereas it used to be this bifurcation of bootstrap, don't take any capital and do that yourself, or get on the venture treadmill, and then you are beholden to obviously your outside investor expectations in terms of growth, et cetera. I think there's a lot of founders who are saying, as you mentioned, I can do more with less today. Maybe I take in no capital at the beginning, but reserve the right to go and approach those VCs later on. Or maybe I take in what we're calling venture light or seed strapping, where you take one round, one slug of capital, get you going, and then you see how far you can get with it beyond, so you don't matriculate up through Series A, B, and C, whatever. You take a seed round, and then that might be the last capital you raise for 5 or 10 years. That's much more on the minds of many, many founders that I'm talking to who are thinking about their ownership and also how much capital do I really need to build a great business?
Yeah, the money raise used to be the vanity. It's really the
Yes.
milestones of acceptance. Anshu Garg over at Foundation Capital, we spar online about this because it's the new $100 million company is probably worth way more than what their valuation is because it takes so much to get to 100 million in revenue. I'm more interested, given you're the data guy. Recently, last week, Carnspace had a big announcement. Historical data is dead. And given Carta is built on historical data, what are your thoughts around that statement and where your data is probably more richly different but valuable in a way? What are your thoughts on that angle?
Yeah, I thought that was a weird pronouncement given that their new predictive analytics are built on historical data. So it seemed odd to me to frame it that way. But I actually love the team over at Crunchbase. We've spoken a lot. I would say that proprietary data assets are only becoming more important as
Right.
we move forward. I think Carta obviously sits on an unbelievable one. But what we're thinking about with our data is more how do we connect the nodes of a network? So in a traditional sort of SaaS where our cap table product began, you might expect that we sit within, all right, we serve founders and we're just going to keep building products that serve the same ICP over and over again. I think one of the interesting things about Carta is we've kind of done this network approach where we say, by dint of serving founders so well and earning that trust, we now have access to other parts of the network. So GPs at venture funds, LPs at venture funds, and then beyond to other private capital sources. How do we build so that the entire ecosystem benefits, not just for each person? And so that's where the fund administration business comes and like connecting the nodes of these network. It's very early stages, but the ways that we can sort of drift between the fundraising world, the VC world, and the LP world, I think are really exciting. And all of that is due to, or a lot of it is due to the data advantage that we have. So I would be shocked if you got a couple drinks in those Crunchbase folks and said, "Well, does historical data really not matter?" I'd be surprised if they agreed with you.
Yeah, I was poking Jaeger on that. We worked together. So yeah, I agree with you. I mean, you can't
There you
have
go.
predictions without history. Nostradamus, right? Like,
Exactly. Exactly. Well, you can have predictions without history. They just won't be very good ones.
right. We all guess.
Indeed. Yes. Some of our guesses are more authoritative than others.
So as you look at teams, there's a lot of talk around fractional help. Are you seeing founders thinking that I don't need to own everything as they look at that makeup? And what is their perspective on fractional assistance? And what do VCs even think about that?
Yeah, we are seeing an increase in fractional roles. They're typically what we see a startup do is they will fractionalize a part of the business that they think they're not quite ready to hire full time for. So the sort of the prototypical example of this is HR. Will they say, "Look, we're a company of 10 or 15. We don't really need a full-time head of HR, but a
Yeah.
fractional head of HR that can help us set up the systems and do all these things, that's totally worth it." So they'll kind of grab that person for a period of time. The interesting thing is that used to be reserved for a few functions. Now I think fractional as an idea has caught on in a way where you could see even fractional things like CTOs, which I'm not 100% sure I love as a strategy, but some founders are approaching it and they're thinking through all of these different ways to arbitrage for talent. So what do I do in terms of fractional? What do I do in terms of where my employees live? Am I willing to go abroad for tech talent that is now much more immediately available to me than it was 5 or 8 years ago? How do I build this business where I am keeping costs as low as possible, but also having access to the right people? Every single founder that we talk to has a different answer for how they're doing that.
Turn a little bit over. If we dig in a little bit deeper in terms of who's getting funding,
Yep.
there was a period of time without those early stage companies. It was your proximity to Sandhill Road.
Yep.
And then it was, okay, who do I know and who am I connected to? Who did I work with?
Yep.
How lucky was I the first time out? And that became the critical element to getting funding, particularly from the top tier firms.
Yep.
Where are we at today? How much of it is concept, and we hear so much, of thesis, but we also hear of traction, right? Where are you at your traction? Where are you at your growth levels?
Yep.
And then team of which you're talking about now. It's sort of how solid is this group? Is it one person that's just the indomitable spirit, or is it 4 or 5 people that all have really strong cred, background, experience, have done it before?
I think maybe this is an answer that you're not going to be excited about, but when we're talking to early stage founders, we always say that you need to expect this to be unfair because it is going to be unfair. Your differential access to capital has not, if anything, it's gotten more unfair lately.
Wow.
So look at some of the raises that you see in the news. Like if you're Brett Taylor and you're leaving Salesforce and you built Google Maps, congrats. You don't have to go out and pitch your traction, right?
Yeah.
Here's hundreds of millions of dollars whenever you want it.
Yeah.
If you are a founder, and we see this all the time where a first-time founder will go out with, call it $1 million in ARR, and they have a product and they have some real customers, et cetera, and they'll look across the way and see a founder with a less developed product, fewer customers, no real traction, get more money on a higher valuation than them. And it's a bet on the person. And it's unfair completely, but it is the way that venture works, where all of these early stage, especially seed stage and pre-seed, they are effectively just betting on that founding team. Really, when you strip away all the metrics and traction, et cetera, because most of the time that's not that real, that material at that point. So it feels unfair to a lot of folks who are getting into venture. It's actually, I think, one of the reasons why this turned towards, well, look, if I'm not going to be quote unquote fairly judged based on these traction metrics, maybe I try to bootstrap this and don't raise until I'm the one with the negotiating leverage.
So we know it's all about risk mitigation, but now I'm sitting there thinking, when they tell you that you don't have the proper traction, it's really that you don't have the right team.
Right. I was
Well,
picking up on that.
I mean, VCs will say a lot of things in order to not say we just don't like it.
Yeah.
So, many of those reasons to say no are perhaps a little bit more about their feelings than yours.
But your statement made is about horse racing and handicapping.
Mm,
I don't know if you've ever
yep,
been to the horse races, but I'm going to look at who was the jockey, what
yep,
race did this horse do? Did it do a quarter mile, half mile, mile? How did it perform?
yep,
And I even have the cheat sheets that, the pink sheets or the blue sheets, and then I can place a better bet, win, place, show, so that I can actually know that I can make money on either of those categories.
yep.
So to Keith's point, this fractional component for you bolstering your team could be a phenomenal intersection that all of a sudden a no-name investor could look more real based upon what they surround themselves with.
Yeah, that's definitely true. It is,
That's
it really does all resolve back to the team, as prosaic as it is to say that. And now the question becomes, um, I don't think that venture as an asset class is very interesting because it has grown so much over the last decade. And there's a lot of big debates about whether or not there are, like, venture as an asset class can handle all of this capital. One of the biggest things that's been in the news or been in the conversation around venture this year is it feels as though we say the word venture capital, but we're actually talking about 3 or 4 distinct industries with your Andreessens and Benchmarks and Sequoias at one end and your tiny emerging managers at the other. And those things, they have different motivations, they have different strategies, they're playing different games. And so it's
Right.
almost as though
Not
we
even
need
the same sport.
a new language to talk about venture because it's no longer just this monolithic thing.
What's that look like?
Honestly, it looks like the biggest venture capital funds feeling and acting much more like private equity firms than they ever have before.
Yeah,
And,
or banks. Yeah.
and
Or I was gonna say
multi-stage
more like a
asset
bank.
managers
Yeah.
and all sorts of things.
Yeah. What about the emerging fund manager? What's the go-to there? What's their play?
It's candidly, it's been a not fun 18 months for emerging managers. So much of the capital invested into venture is now going to these big names. It always has, but it's maybe even more disparate than it has been before.
Just to classify, this is a 10 to $20 million fund or around that size?
Yeah, mega funds, I would say anything over 5 billion. But I think it was something like I think I saw a graphic from PitchBook recently that said that something like 60 or 70% of all the venture investment committed to this year went to nine funds, nine
Right.
firms.
And
So,
which invested in 4 companies.
and sometimes the same four companies.
Yes, that's what I
Which
mean.
is-
Yes. And they all but the good news that rose the valuation, they all wanted into deal. Now, again, that goes back to my kingmaker comment.
Bobby, this is a great point. How actually correlated are the venture returns for the top 5 funds? They have to be like really. I
Yeah.
don't know what the difference is between giving money to a Sequoia and Andreessen. I know that there is a difference, but it does feel as though, look, if everyone's going to be in OpenAI's latest round, then what are we doing?
And there's a
Right.
parallel with the Mag 7. There's an
True.
equivalency on the private top 5 or 10.
Yeah. It's yeah, everything is power law. Power law is spoken about as though it's just a early stage or venture startup thing. I think a lot of things in life are power law.
Yeah.
And now people are now trying to get earlier and earlier and earlier in venture so they can take option bets on promising founders and then kind of hold them through the journey. That idea of signaling risk, where if a founder takes investment from a big VC fund, they kind of have to, they're not now competing with all other founders, they're competing with the other founders at Andreessen.
Yeah.
And if they don't get that Series A after Andreessen led the seed, there's this negative signal to the rest of the ecosystem that's probably unfair, but venture is a game of signals because there's so little data. So you're just always playing in this world of obscurity.
Great. Peter, I love this. I'm going to help start to wind it down a little bit, though. But
Sure.
what's your advice to first-time founders? Besides, it's unfair, and get ready for a long slog and a few welts in the body.
I think the two main points of advice, which are certainly not unique, but I think deserve to be driven home. The first one is there is no more important decision that you will ever make as a founder than who are your co-founders. That is, spend much more time than you think finding the right people. And then we can talk about how you split equity at the beginning and all that kind of stuff. We have some good data on that, but
Yeah.
your co-founder
Do you believe in
matters.
Co-founder agreements then?
What's that?
Do you believe in co-founder agreements?
I do.
Like a
I do.
like a prenup. If this doesn't work out, this happens.
And even more than co-founder agreements, I'd like to concretize those in equity with vesting schedules.
Oh,
Every
yeah.
founder needs a vesting schedule. Do not just grant everybody that 50% of equity outright, and then that person leaves 2 years in, and you're kind of
Upside down already.
Totally.
I try to tell founders protect the cap table. As you go through this, maybe you could tell the importance of that and why. And, again, rereading your article on the seed and the A, and they both get around 20%. It isn't until you get down to like the D, you're only giving up 9.
Yeah.
If we need less people, how does that shift? Like, how should we think about that? Because that's an emotional mountain.
It's so emotional. It's so, when you're a founder, your self-image is tied up in this number, this valuation number, and watching it grow and all of these things. So I can totally understand how this gets blurred by emotion. When we talk about cap table, like what ways to avoid a bad cap table, what most people are talking about there is the concept of dead equity, which means someone owns a big portion of your business, but they're no longer actively contributing to the growth of that company. So the founder example is the typical one where if you and your co-founder split 50-50 at the beginning, but you both get that equity outright, no vesting, you just own it, then if that person walks away, there's 50%, there's 50 points of your cap table gone.
And how
And then
prevalent is
investors
that?
look at your business and say, I like this business, but you do not have enough equity to continue through the venture rounds. it's an uninvestable idea for me
Peter,
because that
how
co-founder is not
prevalent is that
contributing.
today?
What's that?
How prevalent is that?
Well, about 25% of companies on Carta will lose a co-founder in the first 3 years or so.
Yeah.
So co-founder breakups are pretty prevalent. I mean,
Wow.
it won't happen to anyone listening, I promise. But for the rest of the market, it sometimes.
No, we've lived it. We've seen it a bunch of times. I mean, lived it, lived it.
But that's not the only debt equity
Yeah.
idea.
Yeah.
You've got oftentimes when I talk to European founders, they get a little annoyed because they look at, say, the big stakes that some universities, if their spinouts take in
Yeah.
Europe and other places. There's giving too much equity away to advisors who jump on a Zoom call once every quarter and don't really provide much help there. There's lots of ways to kind of
That
be.
that one comes up a lot. I belong to the super founder group, and at least once a week, someone posts, "How should I look at advisors and what do they mean?" I mean, maybe we come up with what's that because you get to see what is a model, and would that be a great follow-on if we're thinking about fractional help? If we really want this to be about helping founders, which is, I believe, and entrepreneurs, and we tell them how to economically not have false starts to get money, the next thing would be how not to spend it, which would be fractional assistance, and you get to see who are the more successful companies that embraced fractional and advisors that drove their business that yes, it may have made their cap table, but they preserved cash.
Yeah. I mean, that is the reason why you would enter into an advisor agreement based on equity alone is because you're cash light for sure. I do find, and this is some advisors dislike me for this. It's very rare that I run across a founder who tells me, damn, I really wish I had given that advisor more equity. But the reverse I hear weekly. And generally speaking, it's not to say that some advisors out there aren't worth every point of equity that they get. Typically, what we see is for pre-seed companies, the median amount of equity that you give to an advisor is 0.25%, so a quarter of 1%, which doesn't sound like a lot because it isn't very much. But if you compare that to, say, your first hire as an engineer, if you are hiring your first employee that's not a founder at your startup, Carta sees between about a 1.5% to 2% equity stake for that person. So
Yes.
compare that to what is that advisor giving you, who maybe you meet with twice a month. I think that you start to right size the idea of how much that advice is worth.
Right.
Right. No, good feedback. What about the idea of the data that you're looking at today that would surprise some people?
Mm.
Things you review on a regular basis that really grabs you and says, this is really surprising. I didn't know this, or I bet the world at large would find this shocking.
Man, there's a number of things that jump
I
to
know one, which I'll give you another minute to think about it, which is
please.
the amount of um, um, underrepresented founders in the ecosystem and how slow that continues to grow. We, in fact, saw a decline in
Yeah.
that recently. So that's one piece of data, and I know you've shared some stuff in this area. That continues to disappoint me. But um, give
A
me your
lot of that we what we think is happening there, and this is a bit of speculation on my part, is
yeah
that as venture capital hit this downturn in 22 and 23,
yeah
there was a return for many investors to, as you said, risk management. And one of the easiest ways to risk manage is to invest wholly or in large part into repeat founders. Who are repeat founders? Much more likely to be white dudes,
yeah.
given where we were before. So it does. I think that some of that decrease into underrepresented funding has to do with this preference for repeat that has been very strong in the ecosystem of late.
Yeah. Any other big ahas? I'm stealing Bobby's question we discussed yesterday. What
I think one of the biggest things that is yet, like, I'm not sure if it's an aha, but it's a shoe that has yet to drop. And I actually spoke with Katie Roof at Bloomberg about this recently, which is unicorns that were minted before 2021. What is going to happen to them? So all these companies that were quote unquote worth over $1 billion during the heyday, it's been 3 to 4 years, 3 years, let's call it, since they really exploded. And so what we see on Carta is only about 30% of them have actually raised more capital. Of that 30%, half raised a major down round.
Yep.
So that suggests that there's a lot more unicorns who have put off fundraising. Have they grown into those valuations? Perhaps. But my spidey senses suggest that there's going to be, like, if you are tired of reading headlines about big startups shutting down, I don't know if 25 is going to be a good year for you because I think we're going to get a few more.
I like your spidey sense. Instead of Peter Walker, we'll call you Peter Parker.
It's been
Really
it's been
serious. I
said
love
before.
spidey sense.
I
Spidey
see
sense.
resemblance too, by the way. There's
Most certainly.
Yeah.
And on that note, with that spidey sense that you see, I mean, you could see the categories that were overfunded because the tailwind of new entrants did it, like RevOps. Think
Yeah.
about all those companies that have billion-dollar valuations. They're not even going to be able to combine themselves and have a billion-dollar valuation.
Yeah, yeah. It's there's a lot of categories. I mean, crypto is the typical example here of like you're either the highest you've ever been or it feels really low and there's no in between. But
So
that applies to a lot of places.
Are we in a consolidator phase, an aggregator roll-up kind of a mode for 25?
Knock on wood, we saw mergers and acquisitions actually increase fairly significantly from 23 to 24. Q4 was actually the total number was the highest it's ever been in terms of companies that were acquired that use Carta. So now let's be honest, a lot of those acquisitions were not super material for the founders or the employees. They were probably fire sales or acqui-hires, things of that nature. But it does point to perhaps a brighter future in terms of M&A this year. We're all waiting. Everyone's waiting for those IPOs to pop back.
Right.
I just think that we're going to get more IPOs this year. I'd be shocked if we didn't, but I don't think we're going to get the big ones. I don't think we're going to get the names that everyone knows.
You're not opening.
Well, they just don't need to go public.
Right. The scrutiny associated with being public now with some of their businesses not being mature enough to understand would just be debilitating for them to grow if you think about it. They wouldn't be able to do the maneuvering that they need to.
That's completely right, Bobby. And on top of that, they now have access to secondary liquidity for their employees in a way where that impetus to go public because your employees are going to like batten down the gates if you don't doesn't really exist anymore. You have some of these companies have effectively unlimited private capital available to them.
Well, and plus they've created these channels to get rid of stock if current team members are looking to, divest themselves of their private capital.
Yep. It's those late
another interesting
offers are much more prevalent than they used to be.
So with your spidey sense, I'm asking one question before Keith takes over. You have a magic wand and the three of us get to go do a startup tomorrow. What is it? What do we do?
Come on. I can't give away startup ideas to the public. That's no fun, Bobby. Oh man, what do we do? I honestly think that one of the things that I would love to do is build AI for unsexy businesses that have yet to be touched by this technological change. I think even in San Francisco, which should be the home of it, you walk around and you see so many places where just a touch of automation would radically change the way that their capital stack works. So
I want to hug you right now so badly because it is the holy grail for small business. I talk about this. 20 years ago, we had billion-dollar companies that built websites, Scient, Viant, Stapleton, Razorfish. Today, you can do that all on your own with, like, you see Goggins, Noggins, head commercials with GoDaddy. I tell the AI to build it. So when you think about that, like, we need to get to that fast with AI so that I don't know the channel yet. Is it an AI SI? We had to create cloud SIs. We would have never, that building wouldn't exist without creating a new class of ecosystem partner. Same happens for AI. I don't know what it is yet. I don't know if it's the Intuit channel because all of those people touch small business. Like it's going to be someone that helps them with that piece. And then it's a domino for them, I believe. So I would love to join you if you choose that journey. It's needed desperately.
I'd love to have you, Bobby.
I think we can get you funded too. I don't know.
Yeah.
I know a couple VCs. I'm not sure they're big fans of me, but maybe we could have at least an intro chat.
We can back them into a corner. Fund us or else.
Fund this or else. I do like negotiating with blackmail. That's an exciting, that's a love of mine for sure.
Right.
Extortion works also.
No doubt.
You don't have a 90-day cycle. It's a 9 hour, 9 minute, 9 second, right?
Exactly. Yeah.
This has been a great conversation, Peter. You can tell we have a lot more that we could dig into, and you're really great to chat with and spend time with us. I think a lot of the insights you've shared will be super helpful to a lot of the founders that've been there and done it, or they're brand new to it, and even to the overall ecosystem. So I appreciate your time tremendously. Keep doing what you do and promoting all this important data that gives us clues into finding the right path.
Absolutely. Yeah, appreciate the time this morning, guys. This has been fun.
Most certainly. I'm looking forward to a follow-up, and I'm in the Bay Area quite often. I'd love to grab a coffee, a beer, or a drink. And one thing I'll ask you to check out is the Failure Museum. My buddy
Hmm.
Sean over at Norwest created it, and what he's realized is you can turn more lessons learned out of failure than you can successes. And I bet you there's a correlation of some of the things that he's looked at and the knowledge of what you see in terms of data that there might even be a great collaboration between you two as it relates to some insights.
Gosh, Bobby, we got to get him on the look back.
He's going to be a look ahead. He's
Look
going to be a look
back.
ahead because, yeah,
You got to look back to look ahead. Well, this is
most certainly. To the point, the data's real.
Peter. I told you this would be 30 minutes, but then Bobby, forced himself onto the call, so we went a little long. I apologize for keeping you late. Send me a bill for overtime.
Absolutely. It's going to be a big bill, guys. I got to be honest, but no, this has been really fun.
Our pleasure.
Enjoyed the time. Thank you so much.
Absolutely. Cheers.